But my next guest, well, he's turned bearish on U.S. equities more broadly and sees better opportunities overseas right now. Let's bring in Marco Papic. He's the macro and geopolitical strategist at BCA Research. Marco, it's great to have you here. I've been waiting to speak with you. Where have you been?
Happy New Year, Kelly. It's a pleasure to be back.
Happy New Year. I don't know where to start, and we have to kind of do this quickly. So let's just do what you do the best, which is cut right to the chase. Why are you turning more cautious on U.S. equities right now?
You know, last year I was bullish bonds. Bond yields coming down is good for U.S. equities, and that definitely turned out to be the right call in 2025. I'm worried that there's stickiness to U.S. 10-year yield. 68% of the U.S. GDP is U.S. consumer, and U.S. consumers do need lower borrowing rates in order to sustain the health of the economy. It can't just be AI capex. So I'm looking for a resolution to the current status of the 10-year yield, which has been stuck at 4.15 for basically since late October. I don't like that. That makes me cautious. Second, AI capex story doesn't look as great as it did last year. Just some doubts about adoption. And then finally, we need some global growth concerns to be resolved. We need to see a little bit more out of China in order to be overall just bullish on risk assets.
Yeah, now I don't like this call because, you know, first of all, we all have 401ks, Marco. But secondly, because you had a pretty good forecast for last year. So it makes me a little nervous. And I think your point is really interesting about the 10-year. It's exactly what we were talking about with Dave Zervos at the beginning of the show, because he's literally pivoting his trades this year where instead of betting on the 10-year yield falling, he's betting more on the shorter end, you know, maybe the shorter end of the curve as the Fed lowers rates. So it's not a great formula. The 10-year matters more for mortgage costs, a lot of borrowing rates and so forth. It's not great that everyone thinks it's kind of stuck up at levels where it's stuck up at.
Well, I agree with Zervos that the front is going to come down more aggressively than the market thinks, but that's also in of itself bearish, particularly if borrowing costs don't come down. Now, look, overall, for the next 12 months, I remain, modestly bullish. My S&P 500 target for last year was much more ambitious. It was 6,950. For 2026, it's 7,500, which is kind of meh. But that's because I expect some volatility in the next 3 months. I expect some downturn. But over the course of 12 months, I think the focus of the Trump administration will move from Greenland to more market relevant things such as housing policy. That's what really Scott Bessent was flagging last year. Donald Trump talked about it over Christmas. Focus on affordability, lowering borrowing costs. If they engage that U.S. consumer who is unlevered, then things can still look good for the U.S. economy over the course of 12 months.
A couple of positive leading indicators. We've had the semis at an all-time high as recently as yesterday or the day before. Dow transports were at an all-time high. Caterpillar's doing well. Copper, Dr. Copper, those prices have been on an upswing. I mean, there's a lot of factors. Actually, I think even Nancy Lazar was writing this morning. There's some good kind of green shoots and leading indicators. And our guest yesterday was saying maybe GDP is actually starting to accelerate. So what I'm thinking about as I rattle that off is the 10-year yield moving higher because of that? And are we sort of trapped, right, where if the prospects look better enough that we don't need more Fed rate cuts, like the market still wants this story of falling inflation and falling interest rates for this rally to continue? I think that's probably even more important than AI.
I'm open for that. Like I'm completely. That's why I'm not in a recession camp and haven't been really for a very long time. So I'm 100% open to the possibility that a 10-year yield is actually telling us something positive. The reason I hesitate to be fully on board with that view, even though I am long copper and industrial metals, is that I do worry that we have been in a cash-driven economy for a very long time. And what I mean by that is that the U.S. government's fiscal outlays have been gargantuan, and they've trickled down to the consumers, and they've spent the cash. The problem is that is finally now out. We need them to start leveraging themselves. And that's why I do think the 10-year yield still does matter. We need it to come down a little bit, not too much. And then we're off to the races, particularly if the Trump administration focuses on lowering that spread between the 30-year mortgage rate and the 10-year yield, which is still, I think, 50, 75 basis points to